Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang, the Chief Strategy Officer here at OptionsPlay, and joining me here with Jessica is a very special guest, Tom Sosnoff from Tastyworks. Tom, first of all, thank you so much for joining us today.
Thanks for having me, Tony. I love these sessions. I feel like we haven't done one for a month or two, so it's great to be back.
It has been a while, and we have a lot to cover here today with regards to option strategies, an opportunity to look at the Tastyworks platform and really help answer a lot of questions that you as viewers have submitted before the session for Tom on option strategy best practices. We're going to try to cover as many of them as possible. Before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities that we are here to discuss as examples for today. So we'll start off by just quick introductions so everyone can most of you are familiar with Tom, but for those of you that are not, a quick introduction as to who he is. We'll talk a little bit about the current market conditions, get his view on his take on the markets, and then we'll talk about some of the ideas and the user submitted questions that we have, and then we'll try to do a live Q&A here at the end if we have a few minutes, and we have a Tastyworks offer here for you at the very end of the session. Now, Tom, normally I have the honor of saying that I wouldn't be here if it wasn't for you 16 years ago watching your webinars on how to trade futures and options on the Thinkorswim platform. But today we're joined by Jessica, who recently joined us as a Director of Education and Product, and she actually has a very similar story to tell. So I'll actually let her tell her story and then give you an opportunity to talk a little bit about your background.
Yeah, I'm happy to. So lovely to host this with you, Tom. My story, very similar to Tony's. And I don't know if you recall this, but it was actually at a money show probably 6 years ago, I want to say, where we met initially. So back up before that, when I was on the trader desk, I grew up watching you and Jen and Lizzie specifically. I actually gave a presentation on the Jade Blizzard so early on. It was something that led to a lot of things in my career. But at that money show, I actually wanted to meet you, and Tony introduced me to you, and that actually led me to my strategy job over at Merrill, where I was running a lot of things, and it really proved great for me. But yeah, I've watched the show for a very, 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 very long time, and big fan. So happy to do this.
That's so cool, because I feel like I kind of remember, but nothing's, it's not all coming together. But over the years we've met so many incredible people, and both in the industry and outside of the industry and as customers. And I always tell people, like, your ability to network and your ability to articulate things and kind of play within the industry, just understand kind of the terms and stuff. It's so valuable in building your brand and building your profession and kind of your professional resume and everything else. And I mean, it's an amazing story. It's cool. I love to hear it. So, and I'm sure Liz and Jenny, they're obviously still going strong on Tasty, and I'm sure they'll love to hear that story too. I'll tell them tomorrow.
Absolutely, appreciate that. Such an advocate for education. So this is great.
Cool, love it.
This is the whole new generation of people that you have spawned, Tom, to carry the torch, if you will, with respect to options education, and we're happy to do it. Yeah, and I hope everyone. Sorry, go ahead.
No, I was just going to say it carrying the torch is a cool thing, and if we can get an entire generation excited about trading and derivatives and everything else, it's just like we've done our job.
Yeah, we've got a lot of viewers here today. So for those of you that are here in this room, please type your name and where you currently are enrolled, because this has grown so much here since we started. We have viewers from so many different countries around the world now, viewing. Auckland here, from here in Australia and New Zealand. So really glad to see so many people on today's session. We've got a really fun session planned for you here today, but I think we want to start off by just talking a little bit about the current market conditions. We've seen the major equity indices sold off fairly heavily here over the past few days, testing some major support levels that we were testing earlier in the year, some of them breaking lower. VIX obviously trading now well into the 30s. Just your general take on the markets and how you're viewing this.
I think I'm probably in the camp of most people that, on the one hand, I kind of felt the market was we came into this year pretty overbought, and I felt like the timing was right for the market to correct. But I think as the market has corrected here, I'm a little caught by surprise by the velocity of this move, especially the last couple of days, Friday and today. I thought, Tony, I'm a junkie. For people that this is your first, Tom event, I'm not one of these people that kind of just talks about things and does. I make a lot of trades, hundreds every day, and I'm truly a junkie. And I really thought after the rally yesterday, I thought we made a pretty good low yesterday, and I kind of liked them on the close last night. So today fooled me. Today really fooled me. I'm surprised by the velocity of today's sell-off, the magnitude of today's sell-off, and what didn't surprise me today was that Twitter was very weak, because I didn't understand that rally in Twitter yesterday. I'm sorry, in Tesla yesterday. So it kind of the whole rally in Tesla yesterday and the fact that it wasn't down early this morning, that kind of threw me a little bit for a loop, because I thought it would be weak. And then as soon as it got weak, it just took the market with it. But I did not think we would see a sell-off anywhere close to this magnitude today. I was expecting a rally today.
Yeah. So, we certainly put in some bullish positions last week, expecting kind of markets to hold here. The sell-off this week certainly caught us out, and we cut losses on quite a few of our long positions here this week. But we've started to reposition here a bit for the bearish side here over the past couple of days. Yesterday actually caught us out. Such a strong day. We were actually expecting further weakness going to the market. So really glad to kind of get your views here in terms of volatility here. VIX above 30. How do you generally factor that into your trading, and how do you position within from a volatility perspective?
Well, I'm a premium seller, as you know. So anytime you get the VIX above 30, you're getting into kind of very frothy, lofty territory for volatility. I mean, the number of times the VIX has been over 35 in the last 35 years, in that 35 to 40 range, you can count them essentially on one hand. So you don't get a lot of, we're at that level now where it doesn't have too much history going much higher than this, but at the same time, you're at that level where you're probably going to see almost just about 2 times the daily expected volatility that you might have seen, under normal market conditions. So instead of, an 18% volatility and moving, let's say, 1 standard deviation, you're getting right now pretty much double that and moving almost 2 standard deviations a day. Today was almost 3. I think that it's, or just the size of the moves is just almost double what it was before. So I think that we're at levels, Tony, where I don't even know if you can say, hey, I love him here or I hate him here, because both sides are going to come into play. You're going to have violent rallies like yesterday, and you're going to have pretty steep sell-offs. A 30+% volatility, all bets are off. You play it, I think you play it from the short side in vol, but you have to keep your position small and play it very liquid underlyings.
Right. I completely agree. So, and we've had some earnings miss at the close here. Alphabet probably being the biggest one here, down $150 when I was looking at it earlier today. Are you playing earnings as well?
I am, but I did not play Google. I didn't play Google because I just don't have a great earnings history in there. I played Microsoft, which I believe if the earnings have come out in Microsoft, I believe it's about unchanged. I don't think it looks unchanged to me right now. I'm watching it. I also played Microsoft, Visa, General Motors, very small, and Spotify, and a little tiny position on in Boeing. So I probably had 5 earnings plays on today, but I stayed away from Google. I just don't have a good history in there, and I guess in hindsight, it was the right move. That's one of those just, okay, lucky I didn't play it, right?
It's good to hear because I think we all have some of those stocks in our history where it just for whatever reason just never works out for us. And for you, it's Alphabet. So good to know. So I think this is a good time for us to transition over to some questions and instead of going over a set number of strategies, we thought the best way for us to talk about option strategies and kind of get a good variety of strategies is to really ask the audience questions. And we got a bunch of great questions regarding different option strategies and your takes on it. So at this point, Tom, if you want, you can share your screen of the Tastyworks platform. Jess and I will go through the questions one by one. And for those of you that are on today's session, the Tastyworks team is on the chat room. They're in the question and answer section. So if you have questions as we go along, anything related to the strategy, questions related to Tastyworks, please type your questions into the Q&A section. The Tastyworks team is here, and the OptionsPlay team is also here to help answer any questions as Tom and I go along and Jessica goes along answering some of these questions. So let's just go ahead and jump right into it. The first question, Tom, that was asked was, what are the best practices to determine the entry and exit on a debit and credit spread? Now, let's break this down into two separate questions. And let's break it down between debit spreads and credit spreads. Let's do debit spreads first. And the question is, what are the best practices for entry and exit for this strategy? And what is your advice on setting stop loss and price targets for a debit spread?
So, okay, so there's a lot in that. So let's talk about it for a second. Let's say you can tell me the month. I mean, best practices would be for us would be, anywhere between 35 and 55 days. But if you want to do shorter term, you tell me, and then I'll go through the best practices. If you tell me do you want May's or June's, just as an example.
So our target date is usually 45 days. So let's use the June's.
So fine, we'll go out to June. And these are Microsoft quotes here. So I'll do something for now. Remember, we're doing debit spreads. So I'm going to show you just a couple little tricks here. So for debit spreads, usually we do debit spreads when the implied volatility rank is on the low side. And we do credit spreads when the implied volatility rank is on the high side. So Tony asked the question about best practices. So we use this number up here, this IV rank. And right now we'd primarily be doing credit spreads because the implied volatility in Microsoft is so high, you can go a little bit further out of the money. But as I'm sure you've learned from Tony, when volatility is really high, credit spreads trade kind of cheap. So debit spreads, for sometimes you might have more bang for your buck. But debit spreads, Tony, what we would do, let's just make it up. Just tell me if you're bullish and bearish for Microsoft. Bullish or bearish?
Let's take a bearish view, just given the market conditions.
So what we like to do with debit spreads is we like to go one strike in the money. So the stock closed, let's say the stock closed at 270. So I might go to the 275s and buy those. And then I might go to the 270s. This would be the cheapest debit spread. This is only $5 wide. And to buy a $5 wide debit spread, so best practices for us on debit spreads. Now, we're not the same as everybody else, but best practice for us on debit spreads is low IV rank up here, and buy one strike in the money, sell one strike out of the money, closest to 45 days, just like Tony said. And what you're hoping to do, let me just move this, we have a little thing down here. What you're hoping to do is to buy this spread for less than, in most cases, less than 1/2 the width of the strikes. But what you're really trying to do is to buy it less than the intrinsic. So what I mean by that is, imagine you're buying here the 75-70 put spread, and you're paying mid-price, it closed at 240, right? Let's just say it's half the width of the strikes, but the stock closed at 270, just over 270. So the actual intrinsic is worth $5. You're only paying you're only paying about half that for this spread. That's because volatility is so high. But what's happening here is you're actually buying a debit spread and collecting premium. It's very rare, but that's what we like. That's a perfect scenario for us if we wanted to buy a debit spread. And the reason you do a debit spread, by the way, is because you have a lower probability of success, but you have the opportunity to make more money. And in this case, you're buying a debit spread and collecting premium at the same time.
Right. So it's a different take.
For us.
Yeah, certainly a different take on debit spreads. And when you use a debit spread with strikes that are this fairly close together, at least from a percentage basis,
Yeah.
it acts almost a bit like a binary option.
Yes,
Basically, at expiration.
you are right. Now, easily we could widen the strikes and go $15 wide by just dragging the short strike down. We would leave the long strike where it is, and we would drag the short strike. Now, if you do it that way, you're paying about a third of the width of the strikes, but you have an opportunity, to make, to make significantly more. You can make $8.50 this trade, risking $6.50. It changes the dynamics a little bit. But again, your probability of profit in this case, you can see statistically is still 51% because you're buying it in the money. So you have a 51% probability of profit, but you're risking 650 to make 850 if you're right. So we like those as a risk reward play. And these are examples of how we would trade a debit spread.
So let's talk a little bit about managing these trades. Stop loss levels, take profit levels. When do you consider taking profits and cutting losses?
Well, ideally, okay, you'd like to give yourself, one of the reasons you do a debit spread 45 days out is because you're trying to give yourself time to be right. But what you want to think about is, remember, this is a June spread. You see June up here. And the expected move in June is $30, higher or lower. So what you want to think about is with the stock at 270, realistically, that stock's not going to get below 240, 70% of the time. So so just going off the statistics, you've given yourself a range of 240 to 300. That's the expected range, and we trust the numbers. So what you're doing as a trader is, if you buy that debit spread to the downside, you're saying realistically the stock could get to 240, but if it gets to, let's say, 255, which is half of the expected move, that's probably a target area for where you might want to take off the spread, or if you get to your short strike. Because you're long a put spread, and if you get to your short strike, in this case, this $15 wide put spread is about 15 deltas. So if you were able to take, which 15 deltas is the equivalent of 15 shares of stock. So you just have to think of it that way, and it picks up a little speed as we get lower and as we go lower. And I think, Tony, my target area on the stock would be around 255 to start taking profits.
Right. So lower strike is where you would look to start taking some profits. What about cutting losses?
Well, with debit spreads, you're only paying 650. Okay. The stock, you have to remember that in debit spreads, when you when you do an at the money debit spread, there's almost 100% chance. It's actually 99.999 that the spread at some point is going to be a losing trade. So you can't just say, I'm going to get out when and if the trade is a loser. What you have to do if you're going to set a target is you probably want to set some mental stop that is, some percentage of it. With debit spreads, there is a very good chance at some point, not only you're going to be a loser, but you're also going to be a decent sized winner. So we like to give ourselves as much time as possible. It's a defined risk trade. There's no urgency in closing out the trade for us. But if you were going to close out the trade, I would do it more based on time than I would based on price. So if 3 weeks go by and we get down to 21 days or in that neighborhood between, let's say, 24 days and 17 days left to go to expiration, and the trade's not working, we probably take it off. It doesn't matter about price.
Right. Okay, that's great insight. So let's move on to the credit side of things. Let's say you're selling a credit spread. What are your best practices for doing that?
So with credit spreads, I'm going to open up a few more strikes. And in this case, Tony, it's really a function. Let me open even some more strikes in Microsoft. So in this case, here's where the current stock is, where this brown line is in the middle. That's the closing stock price. And with credit spreads, what you kind of want to do in our world is we'd like to collect somewhere between 30 and 40% of the width of the strikes. So let's say, for example, and I also want to go out to the expected move. So let's just start there. So let's say the stock expected move is $30. We're currently trading at 270. So I'm going to start at the 300 level just for starters. And I'm going to click on the bid. And then I'll go $5 wide just for starters. Again, I'll widen the strikes later. And I'll say, okay, this $5 wide spread here up at the expected move is only $1.12. That's only 20%, a little over 20% of the width of strikes, that's not wide enough for me. So I'm going to lower the strikes one or one more. I'm going to take it down to 290. And then we start to get closer to 1/3 the width of the strikes. And then we just have to determine, okay, I don't like to go much above the 35 delta. So as my short strike, and maybe I'll make my long strike $10 wide. So this case, we'd be 27% of the width of the strikes. And on this call credit spread, I'd be 27% of the width of the strikes, and I'd probably sell the 290, 300 because I'm right at the 35 delta, and I'm close enough to the 1/3 the width of the strikes. That's kind of how we back into it. Now, it's very subjective, but credit spreads are a little bit different than debit spreads, because if you notice down here, the probability of profit on the spread is over 70%. So what you're doing is you're collecting less money for a higher probability of profit. Debit spreads, lower probability of profit, potential to make more. Credit spreads, higher probability of profit, potential to make less.
Right. So, we take a very similar approach, slightly different strike prices, but same overall concept in terms of how we choose our credit spreads. Just we use a slightly different strike prices to do this, but the same views on implied volatility as well. And implied volatility rank here of 92% certainly helps finding opportunities here for selling credit spreads. So,
and both sides, an iron condor is both sides too, which high implied volatility rank it's a decent trade for 92% in Microsoft, although Microsoft will be lower tomorrow because it was so high because of earnings today.
Right. So let's talk a little bit about management of credit spreads.
So the management of credit spreads, there's a couple of different schools of thought on this. Credit spreads, since you're only collecting 1/3 the width of the strikes, you have a little bit more to lose than debit spreads. And since you have a higher probability of profit, people like to, potentially manage those trades a little bit differently. There's not the 100% chance that you're going to be a loser at some point. So it's a little different than a debit spread. I personally like to manage credit spreads based on time, the same thing as before, but I also like to take profits at about 50%. So if I sold this spread for 268, which is mid-price, and it got down to under $1.50, like somewhere between $1.25 and $1.50, I would probably take profits on the credit spread. I'm like around that 1/2 of the credit received is kind of my target area.
Thank you for those insights on debit and credit spreads. Why don't you move on to the next strategy, since we've spent a lot of time right now covering debit and credit spreads, which is a very popular strategy.
Yeah, so we had actually a slew of questions with this, so I consolidated it into one, but it's really a strategy approach. So what strategy would you utilize when trading earnings, Tom?
Well, when vol is really pumped up, Jessica, like it is today. Now, I understand today's a weird day because the S&Ps were down, over 3%. And I know people get really nervous when vol's up 10%, the S&Ps are down 3%, and it's just a scary time. So I can understand not wanting to do something naked. But generally speaking, when you're trading earnings, my preference is because when vol is high, and remember, when earnings happen, vol is very high. And so my preference is to keep your size really small and to use either, if you're very bullish, to maybe use a skewed strangle, like sell a closer input and a further out of the money call. If you're very bearish, to sell a closer input and a closer in call and a further out of the money put. But I prefer, like in Microsoft, for example, my position, and I'll show you actually, because I have a very simple position on in Microsoft today. This is a classic earnings trade for me. I'm short the 35 puts and the 300 calls. This is my actual position in Microsoft right here. And so this is how I would trade something like this. And if you're asking why, it's real simple. This is oops, I'm sorry, 1 second. Let me just move this a little. This is June. Let me do this. I'm sorry. My position is in May. So if you look at the May expected move up here, Jessica, it is 25.74. And so what I sold today was the 235 puts, or this is the position I actually went home with, the 235 puts and the 300 calls. And as you can see here, with the expected move of $25 and the stock closing at 270, I gave myself just a little bit of room outside the expected move to the upside. And I gave myself a little bit of room. I gave myself 35 points, even though it's only 25-point expected move. And I gave myself 30 points to the upside, even though it's a $25 expected move by May, because of just all the heightened volatility today. So that's how I play earnings. I like short strangles. Now, if we weren't as crazy as we were today in the markets, I might have moved these in, because this would have been the actual expected move right here. And I might have moved them into this level, but I didn't, just because I was a little nervous today about all the activity that was going on, in the markets.
Okay. So maybe perhaps if you didn't want to go naked, you'd
well, if you didn't want to
make
go
a condor
naked,
or something like
yeah,
that.
sure. So if you
Okay.
didn't want to go naked, you could easily just, buy the wings over here. The nice thing about Tasty is, if you don't want to go naked, you just buy wings, and you can move these wings as far as you want apart. And it's totally configurable, but even when I'm doing an iron condor, like, I'll give you an example. Today, I'll show you something. I always got to move these crazy Zoom things, but Boeing had earnings. And I don't really care about Boeing, and I don't even like trading Boeing. And so I went home with a very small iron condor because I don't like Boeing. So my position in Boeing was short the 160 puts, long the 155 puts. And this position I had on was tiny compared to Microsoft position. And let's see, 187.5 calls I was short and 192.5 calls long. Very classic $5 wide iron condor, because A, I don't love trading Boeing. B, I had no feel in there, I haven't traded in a while. And I liked the iron condor better than I liked the naked options. I don't know if I think Boeing's earnings come out tomorrow morning. But to answer your question, Jessica, you're exactly right. If you're nervous about the naked position, then you just do an iron condor. And I have no issue either way. I just prefer naked options.
Got it. So utilizing that implied move to capitalize on the crush. And that's
Exactly.
how you specify your strikes.
When you look at Boeing here, the expected move in Boeing, well, I should give you, this is May, but the expected overnight move in Boeing, I can tell you in 1 second. It closed at $9. So I opened up my May options and we closed at 165. We closed at 167. So I was just inside the expected move to the downside, and about $20 outside the expected move to the upside. And the only reason I did that is kind of for the same, maybe for the reason that Boeing hasn't had an uptick in, as you can see, Boeing hasn't had an uptick in pretty much all this year so far. That's Boeing chart. So I'm just, thinking it's probably a little bit oversold. Maybe it's not, but I'm guessing it is.
Got it. Makes sense. Thank you for the insight.
Yeah, I'm a contrarian. So when I see a stock that hasn't had an uptick all year, I figure, okay, well, I'm not saying that it's not going down. I'm just saying that maybe its downside's limited. So I'll just give myself a little extra room to the upside. At the time I put this on early this morning, I had no idea that we'd be down 150 points or the NASDAQ would be down 700. The time I put this on, the NASDAQ was down like 30.
I don't know if, and many people saw that one coming today.
Yeah, this move here. You can see the futures right now because of what Google, like Tony mentioned, because of what Google did. These futures down 719 in the NASDAQ. Tony, correct me. I don't know if I've seen a 700-point move in the NASDAQ since the pandemic in 2020.
Yeah. This is definitely one of the most violent days I've seen here to the downside.
Yeah, this NASDAQ move down 700. This is including the post market now because of, like you mentioned, Google's down 150. But because of this post market move, this is just an incredible. I never would have. I wouldn't have sold any puts today if I had seen this coming. Of course.
So this actually is a good transition to the next question, which is most of Tom's trades are selling strangles. Would really love to hear your methods and reasons. So I think we've seen a little bit in terms of your methods, right? How you select your strike prices. Could you talk a little bit about why this is kind of your favorite strategy?
Um, I have found over time that I think I'm a little bit more effective with without covering my positions. Like I used to trade with a lot more of my positions being covered, meaning that I would buy, against my short options, I would buy a long option, whether it was an iron condor or a skewed iron condor, whatever it was. But Tony, I think over time, based on the research we've been doing for the last 10 years, I decided that I think I'm better off reducing my size and using smaller size, but without covering the naked part. I just think it's a more effective trade for me over time.
Mhm.
So
And I think that the empirical research of and the efficiency of markets really kind of, to some degree, also um, agree with that from the perspective that implied volatilities tend to be overstates actual volatility, and that's really what you're taking advantage of when you're selling naked straddles and strangles, is selling vol, because the actual move is always statistically speaking higher. I'm sorry, the actual move is always smaller than the implied move.
yeah, and something else that I think is really interesting, if you look at I'll show you on here. Let me just go to implied volatility. So something that I think is interesting that people don't always recognize right away is, let's just say this is the spiders. I just use an example of the spiders because they're so liquid. But let's say, for example, I wanted to sell a 400 put as part of an opening trade. And because I was a little bit bullish, or because I plan on selling the call also at the same time. But what you'll notice here is the implied volatility of this put, just see if you can see where my cursor is, the implied volatility of this put is 31.5. Now, the reason I don't like buying an out of the money put to protect this, let's say $15 away at the 385 level. The reason I don't like buying this put is because the implied volatility here is 34. So I'm selling 31.5 and I'm buying 34.5. And I don't like buying that rich option. So theoretically, this option is more expensive than this option if they were compared dollar to dollar, because this volatility is higher. So the way the volatility smile works, the way the volatility pricing skew works, these options are expensive. So I don't like buying those. So I'm going to delete this leg. And what I'd rather do is reduce my size on this one, or maybe just move it down, 10 strikes if I was nervous. And so you asked me what the logic was behind my thinking. That's the logic.
And this is something that we've also been trying to highlight, which is, there's always the angst, if you will, of selling a naked straddle and triangle because it has true unlimited risk, right? We've seen some of that highlighted with GameStop and AMC as to what truly unlimited risk means when you have a short position in some of these, if you had a short position in some of those names. But I think when you look at it, statistically speaking, over a large number of trades, the amount of premium that you're collecting versus the amount that the stock has to move before you lose that amount of premium is actually quite astonishing as to how much the market has to move against you before you see a loss that's equivalent to the premium that you've collected. And that's something that I think, for those of you that were naked straddles and strangles may be new, I encourage you to take a look just how far the stock has to move before you start to see a loss that's equivalent to the premium that you've collected on that particular trade.
This is very true, but I can't downplay the moves that we've seen in the last couple of days. Some of these moves have been extraordinary. And if you go back and you look at certain earnings plays, like Netflix as being a crazy example, there was no defending a naked position in Netflix, no matter what you did. And so I think that, sometimes you just have to be aware that, you're going to kind of eat your lunch occasionally, and you just hope that it's not that bad. And that is one of the, that's one of the setbacks. That's one of the frustrating things about, taking this kind of an approach.
Yeah. Thank you for sharing with us your insights and kind of the ultimately the risk that you are taking with selling naked straddles and strangles. I think this is a good time for us to transition to the next question.
Sure. So another question about premium selling. Help me understand a put credit spread and when should I use it?
Well, you would use a put credit spread, Jessica, when you feel, and again, everything's subjective. So when you feel that an underlying is oversold, I mean, it's a put credit spread is a directional play, and it's the alternative to selling a naked put. It's selling a defined risk trade, and you're basically, it's a slower moving trade, but you're hoping that the underlying reverses and goes higher. In a perfect world, you want to sell a put spread when volatility is high and when you think the stock price is low. So, like, I mean, you can have your pick of stock prices in this market, but stocks that have been slaughtered, and we just talked about Boeing would be a perfect candidate for potentially, a short put spread. The stock hasn't had an uptick this year. Spotify hasn't had an uptick this year. It had earnings this afternoon. And there's a number of stocks like that that really haven't had an uptick all year. And, those are all candidates for selling put spreads if you believe the market's going to bounce, or if you want to potentially have a few long deltas in those underlyings. But it's a cost-effective, risk-defined way to get small, long, and underlying.
That's a really good way of putting it. Jess, I don't know if you have anything to add, but I think that this is actually a good transition to kind of our next question here, which I think is a question that a lot of investors probably have in this current market condition, especially investors who have a long equity portfolio. And Tom, I'll open this up to more than just options as an asset class. But please explain how you would protect a portfolio during a down market. How can, and in addition to this, there's a secondary part of it, and we'll answer it in two parts, but how can you protect a portfolio against inflation? Why don't we talk about protecting an equity portfolio against downside first?
Okay. So this is I don't like the term, this is a great question, because all questions are great, but this is an important question because this is one of the most misunderstood topics in all of self-directed finance. And what I mean by that is, myself, Tony, everybody else in this business, there are no miracles. There's no easy way, to say, hey, you know what, we're going to do something for you that nobody else has done, or we're going to find a way that, where we can protect you. There is no such thing as a cost-effective hedge, and there is no way to truly protect the downside, Tony, other than there's one way, and that is to stay small. Because by defining your exposure, you are essentially defining your risk at order entry. The biggest mistake that most people make is they just trade too big. It's not that they take too much risk, it's that they trade too big. And it's easy to sit here and say, oh, I would have stopped myself out, or, oh, I would have sold futures against this. But I promise you, that's not easy to do. And very few people will ever do that. And you can say, well, I would have bought puts against this, but you wouldn't, because the premium levels in puts and the amount of volatility that you have to pay to buy those puts is significantly higher than the amount that you stand to make if the market goes the other way and you lose the money on the puts. So it's very difficult to say, hey, these are the ways you can define portfolio risk. You define portfolio risk by allocating the correct amount of capital. Tony, one of the things that you do really well is you are a strong area of concern for you is capital allocation. I've watched that part of what you do. And capital allocation is the single most important thing anybody can do to protect your portfolio. It's all about capital allocation. If you use the right amount of capital, you are effectively protecting your portfolio the best way possible.
Thank you so much for that. And you know, this is we try to cover this particular topic, and we always say every single solution that we present in terms of that you can potentially hedge your portfolio. There's always some major downside to each one of them. Shorting futures, you're giving up all of your upside in exchange for that. So you might as well be effectively out and move into cash. If you buy a put, it's going to be extremely expensive, and they're more likely you're going to actually lose money on the puts than you're actually going to protect your portfolio, especially in the long run. You know, so all of the solutions that we have in terms of potentially protecting your portfolio is really not great at all. So I'm glad that you said that. And portfolio sizing, that's really kind of key. And this is something that we've drilled hopefully into all of our viewers. From every single trade signal that we send out is the number of contracts that we would trade in our hypothetical portfolio, so that you can select the appropriate number of contracts. Selecting the number of contracts is key. And we recently just launched a new feature where you can type in your portfolio size and what percentage of your portfolio you're willing to risk on each individual trade. And with the click of a button, we'll calculate the number of contracts for you. And there's a lot of math behind why we stick to the 2% rule, so that you never allocate more than 2% of your entire portfolio to any given trade to protect your downside in that particular trade. So thank you so much for sharing that.
And that's an awesome feature. And let me tell you something. One of the great questions, everybody listening, there's a ton of people on today, and I'm really excited about that. And please, if you have any questions, Brittany, Christian, Jeffer, they're all on. I think Liz is on too. So we have a ton of people from our trade desk. They're happy to answer any questions. Nothing's off limits. But Tony, here's a little trick. There's a lot of people that like to manage their own money, and they're self-directed, and like everybody we talk to is an active self-directed investor. But there's also people that like to have other people manage their money as well. And I get that. And one of the key questions when you're trying to figure out if somebody's that is a money manager that really understands what they're doing is say, how do you protect my portfolio? How are you protecting my downside or my upside risk, depending on however they trade actively? But most of the time it's downside. And if the answer is anything other than staying small or capital allocation, they don't know what they're doing. And you know more than them. So just that's not an answer you get from a lot of people in this industry unless they are active participants in the market. And even some active participants don't really get that. So I always tell people, ask that question just so you know what you're getting when you hire somebody to work with you.
I'm glad that you said that, because I've been working with thousands of traders over the past 16 years, and the true differentiator between what I consider, traders that have and any chance of success and from everyone else is their focus on risk. The fact that they realize that opportunities in markets are always there, the opportunity to make money is always there, but what you truly only have control over is how much risk you take.
Beautiful.
I think there's a shift that happens too when you first start trading. You make those really wrong mistakes. All of a sudden you become more focused on risk adverse things. And I think that's a really important component, especially in my previous firms and kind of dealing with the other side of things. I've always found that a lot of people who trade options do it with just a portion of their portfolio and sometimes have it outsourced and managed. So I think that's a really great insight for a lot of our listeners. So thank you for sharing that. We do have another question. Well, we have so many questions, but the next one we've chosen for you is, I copied this one more for, I'm going to interpret it a little bit, the wording is, but with the market moving down, is it best not to use a bull credit spread, even if high V exists, because the short upside stocks may be seeming to head south? So if they're bullish on a security, they're still doing a credit put spread, but they feel like the market's moving down. So perhaps that may not work in their favor. What would you do?
No,
even if high IV exists?
That's not actually true. The market, you can't think of it that way. You have to think of it. Listen, if you do a put credit spread, which is a bullish position, you're long deltas. And if the market goes up, your long deltas will work, period. There's nothing else to it. I mean, it's not like, don't overthink it and think, oh my God, we're in a bear market, so there's nothing, we're in a bear market, so there's nothing I can, there's no reason. If you don't want to play the upside, that's one thing. But if you're bullish on something, like I have a couple of stocks that I'm long because I think they're so grossly oversold. I think the downside you know, the downside is risk one, the upside is to make 2 or 3. So there's a couple of stocks, I mean, it hasn't worked yet, but there's a couple of stocks that I'm long because I just think that they're very cheap plays at this point. And if I wanted to do a bull credit spread in there, sure, I wouldn't hesitate for 1 second. I mean, it's as good a trade as any. So a long delta is a long delta. It's a theoretical share equivalent, and it doesn't mean anything else other than that. Don't overthink it.
So I took away one thing from that I think is really important, which is the fact that when you trade a spread like that, the biggest exposure that you have to is delta, which is the underlying stock's movement. Even though there's high IV rank on that particular stock, that in itself is not enough to, let's say, remove the the potential for profit if the stock moves higher. And that's really, I think, the key thing with these types of strategies. And think about it, when you use a bull put spread, it really takes into account both short vol and long deltas, which is, in this type of market condition, if you are expecting a bounce, is going to be profitable on both the delta side as well as on the Vega side. So it's actually, arguably a great condition to potentially sell bull put spreads if you believe that you found a bottom in a specific stock or a market.
Yeah, I mean, just remember one other thing, Tony, though, in this market, because of the extreme volatility right now, we like to use the term no hero crap. So like, if you get a 150 or 200 point rally in the S&Ps, or you get a 300 or 400 point rally in the NASDAQ, like you might think of things in a slightly shorter time frame than you would have in maybe a more traditional or more normal, volatility sequenced market. So that would be the only difference, is we might be quicker to take some profits in a market like this because it's got so much two-sided action. But a delta is a delta. There's nothing else. There's nothing else to it.
Yeah. So the next question, I think there are many questions that were condensed into this one version of the question, which is, what strategy would you choose for a stock that just had a catastrophic earnings report that you would like to play for a rebound in price? Think Netflix, for example.
Yeah. So, I mean, Netflix is a perfect example of a stock that, everybody knows the Netflix story. Stock trades, over 700. Now it's trading under 200. An amazing fall from grace. I mean, I guess it's not that much different than other stocks that have dropped, 70 or 80%, but just an incredible stock given the pure market cap of Netflix. At this point, one of the things I like about Netflix here, and I'm a little bit long Netflix here, so I'm not gonna, and I have to tell you, it did not treat me well today. That's a fact. But with the high implied volatility post earnings in Netflix, and a stock that has, just so people that aren't familiar with it, this is the chart of Netflix. You can see it's all the way down here now. This is a very ugly underlying. This is a stock that I look at, and I'll tell you what my rationale here is. I look at the implied volatility of about 66 in May, and I look at June, it's about the same thing, 62, and I look at the expected move of $30. And I think to myself, on a stock that's dropped down to, the 195 level, okay, so it's got $30 of downside. I kind of like the downside upside risk reward here. So for me, if I'm staying small, this is a very interesting Jade Lizard candidate. And I think early on, Jessica, you mentioned the term Jade Lizard, but Jade Lizard is a strategy that you would use if you wanted to give yourself some upside, some long deltas in a stock with high implied volatility rank, when most of the news is already out. So like I would go to the expected move here, which is about $30, and the closing price, let's say we got to use the closing price. Let's say it was 198, just because it keeps things in line. So this is the closing price where this line is. So I'd go about $30 below this and take us down to about the 165 puts. Okay, that's $30 below 195. That's outside the expected move. And then on the call side, I might go up to, let's just say, maybe somewhere in between the 20 and 30 delta. I'll go to the 25-ish delta or something. I'll go to the 230 calls, and I'll buy the 235 calls. This is a classic Jade Lizard. Sell a put at the expected move distance to the downside on an oversold stock with the IV rank at 65 and the IV at 62, and then sell an out of the money call spread at around the 25 delta, and you're collecting 625, you have zero risk to the upside. The most you can make on this trade is 625. You have zero risk to the upside because you collected over $5, and the most, if the stock goes back to 250, the call spread only goes to $5. So the worst that happens to the upside is you make 125, and to the downside, you are, with your 625 credit, your break even is under 160, and the chances of getting there are under 18%. So this is an 80% probability of profit trade with no upside risk. And that's how I'd play this, Jessica, per that person's email.
Very, very interesting. And just to kind of walk through this Jade Lizard, I mean, I think the best way to, you can also think about this a little bit is you're selling a 165, 230 strangle first, and then you are capping your risk to the upside, or defining your risk to the upside by buying that 235 call option, which is only $5 above the 230s that you've sold. And because you've collected more than the $5 wide credit spread, your risk is zero to the upside. And that's what he's referring, when Tom is referring to zero risk, is because he's collecting more than the width of that call credit spread because of the premiums that he's collected on the put spread. And you are exposed to the downside here, right? So it's similar to an iron condor, where to the downside you're not protected, but to the upside you are. So very interesting way, in my opinion, to play.
And it's really simple on this platform to do it. You just click on the bid, like you're selling a put, and then that would be just a naked put play. And you can see here, probability of success, 77%, just on that put. But then you go up and you click on a short call. Now you have a short strangle, like Tony just talked about, knocks your probability of profit down to 65 because you can lose to the upside. Then you buy this one, and it takes your probability of profit right back up to over what it was on the naked short put. So you're at 78%. That is your theoretical pop or probability of profit. And if you are confused by this, you can just go up to the top of the page, and you could just drop in a Jade Lizard right here and just hit go. And then you can just adjust the strikes by dragging them. That's the beautiful thing about Tasty. Makes it really simple. It just defaults to it, and then it's right there for you. So either way, you just pop it in, and it's the kind of trade, and then you reduce your size, and you say, okay, let's take a look at this trade for a second. So if we did it as a single contract, right? This is a single contract. The amount of delta here would be 17 shares of Netflix. And if you think about a stock that's dropped, that's already dropped, $550, you're buying 17 shares on this position. And that's a very manageable risk reward with a $30 expected move, because 17 times 30 is $500. So they basically 70% of the time, your average loss in this case, worst case, would be around $500. And to the upside, you stand to make, just on a one lot, $600 and up to $650 or $640. But the beauty of that trade is you have an 80% probability of profit. So that's what we like about it. It's just interesting how you use the statistics to basically formulate a strategy.
Right. Thank you so much for walking us through that. So we've covered quite a few different strategies, right? And I would say the Jade Lizard is certainly one of the more complicated strategies, or more complex strategies, that we've covered here. Let's jump back to something far more simple here. The next question is, are deep in the money leaps better than holding the stock? And could you please explain in which case it makes sense, in which case it's not advisable to hold deep in the money leaps versus this, owning the underlying stock itself?
Okay, so let's stay on Netflix, because this is a perfect example. Like we said, high implied volatility, stock it's been obliterated. And I can see a lot of people at this point, they're thinking to themselves, okay, I mean, listen, at 194, I didn't like Netflix at 400 after it sold off $300, but I gotta like it at 195. So what should I do? Should I buy the stock? So let's think about stock for a second. So at $195, if you buy 100 shares, you have to put up 20,000, of which you can borrow 10 if you want, because that's just pure margin. Everybody gets that. So you at least have to put up $10,000 to make this trade. So an alternative could be to buy, like Tony said, a leap, an in the money leap. So let's go to January of, and a leap could be, I don't know what your definition of a leap is, Tony, but let's say, would you say January of 2023 is a leap?
Just by, technically the term is 9 months, so you're just under it. But, I think January in this particular case, for me, I would consider that a long-dated call option.
Okay, so I'm cool with that. So what we do with leaps is, let's say we went to January. As you can see here, it's 269 days. All right, and again, we would look a little bit at expected move, and I'll tell you why in a second. So the expected move with a stock at this particular price is about $67 to next January. Now, the reason that I bring that up is because you have to put some context around, hey, you know what are you doing? Now, everybody's got slightly different rules for buying in the money leaps, but remember, 100 shares was going to cost $10,000. My rule with leaps is I would like to put up no more than 50% of the fully margined amount. So 100 shares of Netflix, I'm just rounding up, is $20,000. Half of that, which is fully margined, which means you have to borrow $10,000 from the brokerage firm, is $10,000. So I don't want to spend more than $5,000 for my leap. So I'm going to go to an option here. I'm going to go a little bit in the money, and let's just go right to a $5,000 leap. And here, the 175 calls are $5,000. It's a $50 option. Now, the interesting thing about that is, now we could sell something against it. We could obviously sell a near-term out of the money option and reduce our cost. But at this point, I'm putting up half as much money, and the delta here is 68. We could round up to 70. It's the same thing. So instead of buying 100 shares, it's the equivalent of getting theoretically 70 shares. And I would probably, if I did this, Tony, just because I'm kind of disciplined this way, I'd probably sell an out of the money call against it. Let's just say, I don't know, something around $5. And I'd save myself a little money. I only have to put up $4,300. So that would be how I would play this particular leap game.
Yeah. So, and is there any conditions where you would say a leap is not suitable, which is the second part of the question?
There are no conditions where I would say, there are no conditions where I would say a leap is not suitable unless we were, like, in other words, I'd be reluctant to buy leaps on very high price stocks near all-time highs. Like leaps, I love leaps when you're doing stock replacement after a stock has been beaten up. It makes me very nervous to do leaps on stock replacement when stocks are really expensive.
Expensive from a valuation perspective.
Yes. Or it's perceived to be expensive.
Right. Okay. Thank you so much for that insight. I think this is a good transition here. We only have a time for maybe one more question here. Jess, I'll let you choose the last question we ask.
I don't like that one either. There's so many. I like this one because it's different, actually. This is the one that was in the queue. Identifying stocks that are worth trading options on. So just when you're trying to choose something, how do you identify an idea?
Liquidity, Jess. It is all about liquidity. So for us, it's all about the volume in the underlying. Now, in days like today, you're going to have a lot of volume, but one of the keys to long-term survival in this business is trading liquid underlyings. So incredibly important to stay liquid. For us, it's all about, if you're looking at a specific underlying, before you even can make the decision to make a trade in there, you have to stay liquid. You have to be an underlying that has enough volume and enough liquidity. If you look at Netflix, for example, it traded 20 million shares today. It definitely qualifies as a liquid underlying. And most of the stocks that we talked about today are clearly liquid underlyings. So in that sense, for us, it's all about liquidity.
One thing I do want to bring up here on the talk of liquidity, because this is something that we stress a lot as well, because whenever we screen for ideas, the first thing we screen for is liquidity, because Tom, for a lot of traders here, they are either fundamental based, they're technical based in terms of how they screen for ideas. But if you look at out of the 4,000 roughly names that are optionable, meaning the 4,000 symbols that you can trade options on, for here at OptionsPlay, we deem only about 200 or so of those 4,000 symbols as what we consider very liquid. And that means you're throwing out almost 95% of potential trade ideas that you might have if you're scanning from a fundamental or technical perspective. And it really ends up wasting a lot of time, right? You have all of your scanners built and you find all these great stocks that meet certain, technical scans or fundamental scans that you have, but 95% of those ideas that you end up may not have a liquid optionable symbol. So, this is a really important aspect of options trading. And Tom, I'd like to hear kind of your views. Out of those 4,000 symbols, roughly how many of them would you say, or estimate, would you say is liquid enough from your perspective to trade options on?
I'm amazed, but I'm in the exact same camp as you. It's around 200. I mean,
Yeah.
Our number varies from about 180 to 240, but that 200 number would be the same number I would use if I was giving a lecture on this.
Yeah, it does depend on the days. Some days you just have more liquid symbols, and other days you just have very few. But the rough estimate number is about 200, and then we have somewhat liquid symbols that when we have a high conviction that we'll still trade, but that still only expands the list out to about 500 to 600 symbols or so. It includes some of the names in the S&P and some more liquid ETFs. But really, and this really speaks to why we use liquidity as a starting point, because unfortunately, if you start your research from a technical or fundamental perspective, you might end up finding that the vast majority of ideas that you come up with, you're going to have to end up trading the underlying stock versus trading an option on it.
Yeah, and I'm just going to give you one example right here. If you look at the top of the page, it's GameStop. And, who would have thunk, but, just a year and a half ago, when everyone went through the whole meme stock kind of explosion, GameStop one day traded almost 400 million shares. And it went from a no-name play to one of the most liquid stocks we have. And if you look at volume today, it's 1.5 million shares. It doesn't even make the list today as liquid enough to trade. And if you open up June options, and I looked at the volume today, I mean, look, you can see it's a measly, few 10 lots, a couple, whatever. And if you look at the width of the markets here, they're $3 wide. They're untradeable. So here's a stock that went from being incredibly liquid to basically being untradeable in a year.
Right. And I'll just ask you one more question on this, because we get a lot of questions on this front. I think there's still some misunderstanding as to just how to measure liquidity. We have a lot of traders that will, you pull up a name, and even in some, maybe not Microsoft and Netflix, but take a slightly less liquid name than that, maybe something like Goldman Sachs. You're still going to find strikes or individual strikes where there are relatively low volume and open interest, especially perhaps on some of the weeklies. What are your thoughts in terms of looking at open interest and volume for an individual strike? Because sometimes, we've heard from traders that will say, I won't trade a specific strike because that strike has low open interest and volume. Do you mind just expanding on kind of your thoughts as far as that view and how you actually measure liquidity?
So, well, I'm glad you asked this question, because I'm a liquidity freak. And a stock like Goldman Sachs it traded, to almost 3 million shares, which is pretty normal for it, but it's an expensive stock. The markets in here are okay, not great. The volume is fair, not very good, but it's fair. But what we do on Tasty is something I don't know if anybody else does it, but we actually have a liquidity meter built into the platform. So as you can see here, we have Goldman rated 3 stars out of 4. And if you go to our watch list, on our watch list, forget about these are positions. Let me just go to liquidity, high option volume stocks. So what you can do on this platform is search by liquidity. So these are all 4-star liquidity. Actually, I don't have this opened all the way, but these are all 4-star liquidity. You can see them. So what I do is I search by liquidity. So we show you 4 stars, and then these are all the high option volume. These are what you were just talking about. And as you can see today, there's probably about 200, or I don't know exactly how many are in here, but probably close to 200 that we show as high option volume with 4-star liquidity. And that's very interesting. So we do a lot of the dirty work for you, and we do it through AI right built into the platform. And I think only Tasty has something like that, but it's built into, you know, every underlying. So if I went over here, just as an example, to GameStop, you can see it's only 3 stars. It doesn't reach the 4-star. We like trading 4-star liquidity, occasionally 3 stars, but we will avoid, you know, 2-star underlyings.
Perfect. Thank you so much for sharing that with us. And I think this is a really good transition to ending the session here today with an offer from Tastyworks, where if you want to access the platform that Tom was showing you and access to being able to trade using that Tastyworks platform and accessing the liquidity indicators, you can do so using the link here on your screen and open a Tastyworks account and get $200 worth of stock on Tastyworks. The link for that is trade.optionsplay.com/Tastyworks. I've posted the link into the chat window here as well. You know, sign up for that Tastyworks account. This will give you access to the platform that Tom was showing you. You can follow Tom's trades. You can follow everyone at Tasty Trade and Tastyworks in terms of the work that they do in educating and providing ideas to their customers. So really excited for those of you that are already on Tastyworks, and for those of you that are in the process of starting your Tastyworks account. Many of you have been following recently on trading small futures and accessing those products. You know, that is also available to you in your Tastyworks account. And we're actually doing a session this Thursday on trading small futures. So I hope that you'll be able to join me for that particular session. And with that, Tom, I just want to thank you for taking your time out here this afternoon. I hope that this was helpful for everyone that was viewing this today, to give you some insights into option strategies and how Tom trades these particular strategies. Tom, thank you so much for your time.
Thanks, Tony. Jessica, great to meet you finally, and
Thank you.
or again. And thanks so much. And thanks so much, everybody, for hanging in there with us today. My email is tom@tastytrade if anybody has any more questions. And have a great week, and good luck, everyone. Fingers crossed.
It is,
Take care.
it is a challenging week, but I agree. For those of you that want to access OptionsPlay, you can do so at OptionsPlay.com, the platform that we have to find ideas that you can use to trade these types of option strategies. And you can now download both an iOS and Android platform by pointing your phone on your screens to that QR code here on the upper right-hand corner. So with that, thank you so much for your time here this afternoon. Again, please type your questions. Type your questions to the Q&A section. We will try to answer as many questions as we have time for here today. And if we can't answer your questions, we will respond to your questions by email. So please, if you have any remaining questions, type them into the Q&A window. The Tastyworks team is working hard to try to answer as many questions as possible. See, more than 70 questions have already been answered. So hopefully we've been able to answer all of your questions before we have to jump for today. And this session is recorded, so we'll send you both the recording and the slides in about 30 minutes or so after we finish this particular session. Okay, I think we're gonna wrap. Thank you so much for your time this afternoon, and I will see you on Thursday for our next event on futures trading. Thank you so much and have a great trading day.
Thanks, everyone.